Looking at the markets today, the Dow Jones Index was up 200 points and the FTSE also rose by 70 points. Why do stock markets move like this every day?
Well, it's a good question. On the whole, stock markets move on fundamentals, and these can be of two kinds, macro data and micro data. Firstly, there is the macro data, that is to say the inflation rate, interest rates, unemployment figures, those kinds of things. If, for example, the market begins to expect a fall in interest rates, like today, this is good news for share prices because it will be cheaper to borrow money in the future. So it is more interesting for companies to invest and for consumers to spend.
Yes, but surely investors are also looking at particular companies.
Yes, that's right. That is what we call the microdata, the things that affect a particular company, like a company's results or news of a big contract win. If a company announces good financial results, the analysts will probably upgrade the stock, thinking it will make more profit in the future. This will attract buyers, so the demand for the stock goes up and the share price will increase. The share price is simply telling you how much money people think the company will make in the future.
So we should be reading company announcements carefully.
Yes, of course. But we should also remember that a company's share price may be affected by the news of a competitor in the same sector. This can cause analysts to change their view of a whole sector. But institutional investors are really looking more at the longer-term trend. Is it going up or down?
Okay, but who are all these investors?
Well, generally speaking, there are two kinds of investors. There are the retail investors. That means ordinary people like you and me who are buying and selling stock. And then there are the professionals, what we call institutional investors. Obviously, in today's markets, the institutional investors are the most important and account for most of the day's volume.
You mentioned these institutional investors. Who exactly are they?
In general, there are 4 different kinds of institutional investors. First, there are the pension funds. Then there are hedge funds. The third kind is investment banks. And finally, there are insurance companies. All of them manage money for clients and make the investment decisions for them. In recent years, the new players here have been the hedge funds, who now account for about 30% of daily trading in London.